Joining us now with his best ideas in all this, Matt Orton. He is Chief Market Strategist at Raymond James Investment Management. Matt, I'm not going to sit up here and make too big of a deal about a 0.5% decline in the NASDAQ. It's summer, volumes are light, but you have to admit there's been this everybody's been kind of waiting for this rollover, broadening out, rotation, whatever you want to call it. And every time we see a move, we ask if this is it. What say you?
Hey, Brian, it's always great to join. And I think this rotation that we're starting to see is probably another head fake. It doesn't mean that breadth and balance in portfolios isn't working, because it absolutely is. It's just a lot of the themes are related to the big, longer-term, durable growth themes like we've talked about before, leaning into artificial intelligence, kind of the industrial exposure to it, how utilities are exposed to it. What we're seeing in technology right now, I think, is a little bit of exhaustion. Perhaps some of the crowded names like a CoreWeave that disappointed on earnings were the start of some profit taking heading into Labor Day. This is also a seasonally weak period in the market. And frankly, a lot of investors have been waiting for an opportunity to redeploy some capital into these names. So I encourage all of our clients to really use this downside opportunistically to lean into those higher quality, strong secular growth names that are going to be durable going forward, because these mega caps have a ton of cash.
Like what? Give me an example of what you would listen. No one ever says we want to own only low quality companies. No, high quality. So what does high quality mean to you and your team, Matt?
Yeah, so quality to me means you've got to be generating free cash flow. You've got to be growing both your top and bottom line. And so a mega cap that looks incredibly attractive right now is Alphabet. You've been talking about it in the previous segment about some of the technology they're releasing. But quite frankly, here's a name that's valued less than the S&P 500 with tremendous top and bottom line growth, a rock-solid balance sheet, and a lot of different growth drivers, not just in artificial intelligence, but in traditional search, where everyone quarter after quarter is saying their search engine is going to be eaten because of AI. It hasn't happened yet, and I don't think it's going to happen. So this pullback makes it an even more attractive opportunity to get into a strong name like Alphabet going forward.
Why are you so confident that the death of Google search is not going to happen?
Because we're all trained. I mean, Brian, where do you go when you want to search something? Most of our first instincts are, we're just going to Google it. You put it into Google, it's integrated into our browsers, into our phones, and frankly, we're so used to doing so, and the results are high quality, but the ad revenue they get from that, integrating it into YouTube, putting Gemini into those search functions, I think all of that just creates a very well-rounded system that people continue to utilize no matter what everyone says is going to eat that lunch. It might happen over the longer term, but we're not seeing that in any of the data, and their earnings results continue to be very, very strong. So I would lean into the fact and what we're actually seeing happen with the company, and how they're able to use all of this new technology to their advantage.
Not a lot of companies become verbs. To your point, Matt, here's a new name that you like. Phreesia. I kind of know what they do. Software, healthcare. That's about the limit of my knowledge on Phreesia. I'm not going to sit up here and pretend that I'm some expert in a company. It's not a small cap, but it's kind of a mid-cap-ish. Who is Phreesia? Why do you like them?
Yeah, it's a great question. It fits into me also liking smaller companies right now. We're seeing good earnings growth and top line growth finally starting to improve down market cap. Phreesia is a great example. It's a health tech company. Basically, they create software that you're able to use to log into your medical appointments. They also created a payment system for a lot of your doctors, some of the smaller processors to help encourage people to pay on time. So it's a subscription-based revenue service, which is great, because it's visible revenue and cash flow. And then they also have add-on services that companies can use to help them better integrate patient data. So the company looks very attractive because, again, they're free cash flow positive, and they're expanding their margins because they're able to retain 90% of their clients and continue to build on that base with more upsells. So when you think of durable growth themes, more and more people are going to the doctor. We've got to find a way to integrate technology into what we do, so we're not all clicking on the iPads every single time we go into the doctor. This is one way to help get around it, and they're seeing a lot of good retention, and that's what I like to see in a company in order to keep growing their margins.